When you start to see people queuing up at a shop in Martin Place to buy gold, that kind of rings alarm bells to me. Diversifying away from US Treasuries and into gold, do you think that still has legs?
So what do you want to talk about?
Well, let's start by talking about Japan. Then we can talk a bit about gold, which has been topical. And then we can talk about Australia and let's see how we go from there.
Sounds good.
Okay, let's go.
So, episode 2.
Episode 2, we got invited back again.
What about we start with Japan?
That's a really interesting one, because I think we've certainly been long-standing and for a while long-suffering fans of Japan.
Yeah.
But it just seems something really fundamental and structural in corporate life in Japan is really starting to happen. We think it's still got legs, but I just think the Japanese equity story is done pretty well for us.
And, middle of October, Sanae Takeichi, first ever female Japanese Prime Minister, very much in the mould of Abe. And so
yeah, very much so.
That kind of fiscal stimulus and trying to reflate the economy. But Japan's changed a lot.
Well, that's right. Yeah, I just think that I remember some years ago when we went there and we sort of were prepared to give Japan the benefit of the doubt, but we thought it would be a slow burn. And that's certainly the way it's panned out. And, things don't move quickly there, but we just do think that the economy and certainly that sort of drive towards a greater focus on shareholders and rewarding shareholders who are putting up the risk capital, we think that's got more legs. But it's interesting, the reflation story, be careful what you wish for, because you've now, after decades of waiting, you've now starting to see some sustainable inflation there.
That's right. I mean, if you look at the inflation for 2025, Japan's kind of one of the highest inflation numbers, at least headline, over the course of 2025, and that's unusual. I mean,
very much so, very much so.
From falling prices and deflation 5-10 years ago.
Yeah, absolutely.
But I think Takeichi's going to have a tough job because she doesn't have a political majority.
No,
and
right.
So
you can see Japan headed to the polls in about 5 minutes if this keeps up.
Yeah, that's right. I mean, the breakdown of a conservative coalition and the establishment of a new coalition in Japan means they no longer have a majority. So it's a tough balance between political stability. The monetary side's tricky. I think the consensus is the Bank of Japan needs to lift interest rates beyond the 50 basis points where they are, and they want to provide kind of fiscal stimulus. It's quite a difficult juggling act for Japan at the moment, but it's a lot more normal than it was perhaps 5 or 10 years ago.
Yeah, absolutely, and that's great. As I said, it was a slow burn. We're pretty happy about it because certainly being overweight Japan in our own portfolios has helped quite a bit, sort of offsetting the fact that we've been long suffering underweights in the United States.
Hey, there was something I did want to talk to you about this episode, and that is gold.
Oh, well, you had to bring that up.
Come on. Your
Look,
next door neighbour's been talking to
Full disclosure,
Yep.
I have been the world's worst gold price forecaster for 20 years. But let me say, I do worry when you start to see people queuing up at a shop in Martin Place to buy gold, that kind of rings alarm bells to me.
Yep.
So I do worry about that. But timing that is obviously impossible. But especially when, I see that and I see that sort of level of retail interest, and that scares me. But at the same time, this structural story about a range of investors, some of the major central banks, diversifying away from US Treasuries and into gold, do you think that still has legs?
Well, one of the things about the gold market is that it's much more than just investment. So if you look at annual gold demand, 50-60% of annual demand on average is actually for jewellery and industrial purposes.
Yeah.
So you've got this burgeoning demand that has nothing to do with investments. You've then got central bank buying. World Gold Council is predicting that 2025 will be the 15th straight year of net buying by central banks. And then you've got the kind of the investment story, either in managed funds or ETFs or in kind of coins and bullion. So it's quite a diverse market. But I think for me, the story is actually diversification rather than price. So if it gives you any consolation, I think trying to predict the gold price is a very tough game.
Oh, very much so.
However, gold is a diversifying asset that can be defensive in times of inflation or market volatility, and that is also highly liquid. That kind of role within a portfolio, I think, stays very interesting. And if you look at other non-correlated assets, broad scale commodities or liquid alts or private markets, that mix of defensiveness plus liquidity plus low correlation in a portfolio, it's not a bad little piece to have.
I don't mind, and I accept that as a strategic argument, but my gut says I'd much rather have a better entry point than this one.
Yeah. And it's certainly the entry point. What are we, US 4,000 now? I mean, it's come down from 4,300, which is good, but it's still certainly at the top end of what anyone thought 12 months ago.
Absolutely.
That's certainly true.
But that's the thing, it could still have legs, even though you have people queuing up in Martin Place too.
So tell me, what are you seeing in the Australian economy?
Well, look, I think that it's very uneven is the way I would describe it. I count myself as cautiously optimistic. That's a very economist phrase, I admit, for the next 12 months or so. Yes, lower rates will continue to feed through and to modestly boost the consumer. Inflation's been a bit sticky, but at least you've seen real wages start to grow again. So you're now starting to see some modest growth in, real per capita income, etc. So I do think that does boost the consumer a little bit. Yes, I do think you'll see a bit of a pickup in housing construction, and not before time. We roughly need about 250,000 houses. Yesterday would be good. But at the same time, we've still got another couple of rate cuts penciled in over the coming months. Yes. But it's fair to say we're probably a little less convinced of that than we were some months ago, given that the inflation numbers have been a bit stickier.
Yeah, we've got a couple penciled in. I don't know the market necessarily has more than one. We've got a couple penciled in, but maybe not as soon as we thought. You might be well into next year before you start to see those couple of cuts.
Yeah, I think probably next year's a better timing.
Yeah, it was a bit of a shock that the CPI number when it came out. So.
It was, and especially I know people there's always an attempt to rationalise it and sort of say, oh, but it was this, it was that, or whatever. But when you looked at a range, the headline rate picked up, the trim mean picked up, the market sector goods and services, ex-volatiles, that picked up. So it was almost like, even though that market sector number is still within the target band, it still counts as a miss.
Yeah.
And so from a forecasting perspective and a policy perspective, it probably says you bide your time for a little while.
I mean, there's a part of me that looks at US history, for example, where an inflation rate of high twos is actually associated with pretty robust economic performance.
The 1990s was a boom time.
And so I think there's been a little bit we've had this spike of inflation. The last 50 to 100 basis points are always the hardest to get.
Yeah.
But I think you've got to step back and say, well, if inflation is under 3, either in the US or here, we're like kind of where we need to be.
That's right. And I think that one of the themes we discussed overseas as well is this idea that if you're a central banker and you see the political environment and, certainly central bank independence has at least come under some question, notwithstanding, particularly given the comments of the US president about the Fed chair and others, in that kind of political environment, is getting inflation down the last 25 to 50 bips the hill you want to die on? I'm not sure it is.
Yep.
And it's almost like when you look at the behaviour of the central banks, they've been willing to cut interest rates, even though they haven't hit target yet. And, and yes, you can forecast that you're heading back there, but it's still a brave call.
Yep.
It's almost like, maybe we need to work on the assumption that, inflation on average is going to be a little bit higher than perhaps the decade we were used to pre-COVID, and the central banks will be fine with that.
Yep.
And frankly, the economy will be fine with that.
Yep. I mean, there's a whole generation that needs to get used to that. For me, 3% inflation still sounds fabulous, but that's because I'm old enough to remember other eras. I mean, we've got very long-term equity returns at maybe 6.5% to 7%. So sitting down with a financial advisor to plan your portfolio, we've got long-term numbers of maybe 6.5 to 7, bonds at maybe 4, something like that. That gives you a rough guidance about what you should be thinking for that sort of really long-term planning. Yeah,
that's very similar to our own capital markets assumptions that we use for asset allocation. It's in that ballpark. Yeah. And that's reasonable. Yeah. But also part of the challenge is educating members of superannuation funds that have really been getting used to double-digit returns for the last decade, that the future doesn't look quite as flash. I hope I'm wrong. I'd much rather be pleasantly surprised than bitterly disappointed. But having that sort of more single-digit mindset for equity markets and for diversified option returns is probably a healthy expectation to have at this point.
I mean, the only assumptions we've got that are above 7% would be in things like private equity and private credit, but you've got liquidity issues that need to be carefully managed there.
Yeah. And just the final thing too is that at least now it's a better time to be transitioning to retirement, because at least if I'm transitioning to a more conservative portfolio, I can actually hope to get a positive real return out of my bonds. Hallelujah.
Well, was that a first-person statement or a stylized first-person statement?
A stylized first-person statement. I'm still going to be annoying you with these quarterly things for another few years, that's for sure.
So we are going to have an episode 3 then?
Hopefully if we get invited back.
Looking forward to it.
Good on you. Thanks, Jonathan.